Good morning, good afternoon, good evening to all participants who are joining us from different places from Africa and beyond. Welcome to this expert talk, series webinar on access to finance for agro-industrialization in Africa. So our focus today is going to be very practical. How to connect the financing objective of CAADP Kampala agenda with a stronger agro-processing performance, better use of production capacities, and greater value addition. On behalf of our organizers, or our co-organizers, AUDA-NEPAD, the GIZ Agribusiness Facility for Africa, Catalyst, the Shamba Center for Food and Climate, and the Zero Hunger Coalition, I thank you for joining us with a strong. We also acknowledge all the other partners who have been supporting us and whose logos are displayed on the different materials that has been displayed and that has been shared. So this webinar will be in both English and in French. There is, I think, at the bottom on the setting or on the section that say more on your webinar. If you click on it, it will give you like the different option to listen to this webinar either in French or in English. But also the webinar is live streamed both on YouTube and on LinkedIn. We will begin with institutional partners' perspective, followed by evidence from the study, the experience of financiers and enterprises. We'll have a moderated discussion, and then we'll have a practical exchange with participants. So our purpose is not to discuss finance in the abstract. It is also to identify what makes finance productive for agro-processors and what must change for investment to translate into stronger enterprise performance. So it is now my pleasure to invite my former director and colleague, Mrs. Estherine Fotabong, who is the Director of Agriculture, Food Security and Sustainable Environment from the African Union Development Agency, to give us a few welcoming remarks. Mrs. Fotabong, you have the floor. You are muted. Your mic is muted, madam.
Okay, thank you, Dr. Diop. Hope you can hear me. I'm still recovering from a bad flu, so my voice might be a bit heavy. But can you hear me? I hope.
Yes,
Can you
we
hear
can
me,
hear you.
Hamadi? Okay.
Yes, we can hear you,
Thank
madam.
you. Oh, thank you. Let me say again, well, thank you, Mr. Moderator. Let me acknowledge the partnerships, the organizations that we have to working together to jointly organize this very important webinar. First, let me recognize Mr. Dauda Simbeni, the CEO of Catalyst. Let me also recognize Ms. Lynn Field-Cotter, the head of program of GIZ. Recognize all the representatives from member states, government representative, financial institutions, from the private sector and from development partners who have joined us in this important expert talk. Ladies and gentlemen, welcome again. Let me add my voice to Dr. Diop to welcome all of you. This webinar contributes, expert talk as is on access to finance for agro-industrialization in Africa, contributes directly to the implementation of CAADP Kampala Declaration and the CAADP Strategy and Action Plan of 2026 to 2035. Particularly on strategic objective 1, which is on intensifying sustainable food production, agro-industrialization and trade, and of course on strategic objective 2, which is on boosting investment and financing for accelerated agri-food system transformation. The Kampala Declaration recognizes that transforming Africa's agri-food system requires more than increasing agricultural production. It calls for competitive, resilient, and market-oriented value chains that connect farmers to processors, regional markets, and investment opportunities. Achieving this vision requires coordinated public and private investment in agro-industrialization, infrastructure, logistics, technology, finance, and enabling policy reforms. Within this context, access to finance is not an end in itself, but a strategic enabler of agro-industrial transformation. Greater investment in agro-processing, storage, logistics, and value addition will reduce post-harvest losses, will strengthen food security, and create quality employment, particularly for women and youth, and enhance the competitiveness of African agri-food value chains. This webinar is therefore provides a timely platform to examine how innovative financing mechanisms, public-private partnerships, and investment-friendly policies can accelerate agro-industrial development across Africa while supporting the Kampala Declaration ambition to mobilize more than USD 100 billion in public and private investment for agri-systems transformation. By bringing together policymakers, development finance institutions, private investors, agribusiness leaders, and development partners, the discussion will identify practical solutions to reduce investment risk, improve returns, and unlock commercially viable value chains. Ultimately, this webinar advances an integrated approach in which increased investment drives agro-industrialization. Agro-industrialization generates value addition and reduces post-harvest losses. Value addition creates jobs and expands market, and competitive value chains strengthen intra-Africa trade while positioning Africa as a globally competitive agri-food economy. This virtuous circle lies at the heart of strategic objective 1. So therefore, I encourage all of us to engage and openly participate in these very important conversations that we're going to have in the next 2 hours. Thank you, Mr. Moderator, and back to you.
No, thank you, Madam Fortabong, for grounding the webinar on Kampala and focusing mostly on the issue of value chain, market linkages, and competitiveness. So let me invite Mariam, who is sitting here, who's stepping in for Dauda Semen, and also who is Deputy CEO of Africa Catalyst, to give us her opening remark. Mariam, you have the floor.
Just great jobs and big titles.
Thank you. Thank you very much, Dr. Diop. Distinguished colleagues, esteemed partners, panelists, and participants, good afternoon, good morning, good evening, wherever you're joining us from. It is a pleasure and a privilege to welcome you to this second expert talk series on access to finance for agro-industrialization in Africa. I would like to begin by appreciating our partners, AUDA-NEPAD, the GIZ Agribusiness Facility for Africa, Chambers Center, the Zero Hunger Coalition, and all the institutions represented here today for your continuous commitment to strengthening Africa's agribusiness ecosystem. This webinar is part of an important conversation on how Africa can move from financing commitments to financing that delivers real results for enterprises, farmers, value chain, and economies. Building on our first webinar, today's discussion shifts from identifying financing gaps to exploring how finance can strengthen agro-processing, improve productivity, and transform value addition. This discussion comes at an important time as Africa advances the CAADP strategy and action plan 2026-2025 and the Kampala Declaration, both of which place agro-industrialization and value addition at the center of the continent's development agenda. And the real test of these commitments lies in their ability to improve the performance and the competitiveness of the enterprises that drive Africa's food systems. Across Africa, agro-processors continue to face serious operational limitations. And evidence from AUDA-NEPAD and GIZ-supported studies across Kenya, Malawi, Ghana, and Nigeria has shown that many agro-processors continue to operate below their capacity. While access to finance remains a challenge, enterprises also face obstacles related to infrastructure, technology, storage, supply chain, skills, and market assets, as Dr. Esserine Fotabong clearly stated earlier. And this reminds us that the finance is crucial, but finance alone is not enough. At AfriCatalyst, we believe financing commitments should be measured not only by the amount of capital mobilized, but by the impact it creates. And finance should enable agro-processors to improve productivity, expand value addition, create jobs, and become more competitive. This, however, requires moving beyond financing alone and investing in the broader ecosystem, including technical assistance, infrastructure, market linkage, business support, and stronger value coordination. So today's discussion provides an opportunity to explore how financing can improve operational performance, strengthen value addition, and support enterprises in reaching their full potential. It is also an opportunity to identify practical actions that would help translate the ambition of the CAADP Kampala agenda into tangible outcomes for agro-processors across the continent. We are proud to work alongside partners who recognize that agro-industrialization requires collaboration between governments, development partners, financial institutions, investors, and the private sector. Together, we can ensure that the financing is better aligned with realities and needs of the African enterprises. AfriCatalyst remains committed to advancing financing solutions that support Africa's development priorities. And our goal is to ensure that finance strengthens productive capacity, support enterprises' growth, creates jobs, enable Africa to move further up the value chain. For agro-processors, this means finance must help them move from survival to scale. Colleagues, Africa does not simply need more financing. It needs financing that works, financing that strengthens agro-processors, builds resilient value chains, and delivers on the ambitions of the CAADP Kampala Declaration. I look forward to today's discussion and the insight that it would emerge, and thank you very much and wish you all a productive and engaging webinar. Back to you, Doctor. Thank you very much.
Thank you, Mariam. We need financing that works. This will resonate very, very strongly in the next few minutes in the discussion. So our first webinar focused on access to finance and de-risking, as you rightfully put it. And we benefited significantly from the experience of the ABF, which is the Agribusiness Facility of GIZ. So I'm pleased to transition. I'm pleased to invite Simon Striegel. I hope I am not mispronouncing your name, Simon, who is the head of Component GIZ Agribusiness Facility for Africa. Simon, please share your perspective.
Thank you, Hamadi, and much appreciated for this nice introduction. Greetings to you all. Good afternoon. I think we've heard a lot of critical words already from Madame Diop and Madame Fotabong, but let me also share a few perspectives from our side as GIZ Agribusiness Facility for Africa. Of course, together with AfriCatalyst and AUDA-NEPAD, it is an absolute pleasure and privilege for me to welcome you to this, I think, quite crucial expert talk on access to finance and agro-industrialization on behalf of GIZ's Agribusiness Facility for Africa and our head of project, Ms. Lynn Feldkötter. Lynn would have loved to be here with us today, and she does extend her warm regards to you all. Agribusiness Facility for Africa, in short, ABF, is a regional GIZ program. It is co-funded by the German Federal Ministry for Economic Cooperation and Development and the European Union under the Joint Action Business Support Facility for Climate Resilient Value Chains. The program mobilizes private sector investment and prepares agribusiness across the continent for economic and climate resilience, and is thereby paving the way for sustainable growth in the sector. And we do this in close partnership with African Union Development Agency, AUDA-NEPAD. And I would like to emphasize this is a partnership that is very strategic and dear to us at GIZ, and it is a lasting one, as we've been working together for many years now. And we do share a joint vision of strengthening value chains across Africa at micro, meso, and policy level, as well as promoting public and private agribusiness investment across Africa. And a key instrument in this effort is a dedicated competitive matching grant fund that ABF is implementing, through which we support 65 private sector-led consortia in scaling their business models to promote resilient cocoa, livestock, and maize value chains. And we have presented this matching grant fund in the first edition of this webinar, not only as a mere instrument to bring working business models to scale, but also as a broader de-risking mechanism that, based on the successful track record and the partner performance that we can show, has already proven to attract more private funding for an even larger impact across value chains in Africa. And more recently, together with key public stakeholders in Kenya, over the last couple of weeks, we have developed a concept how this matching grant fund scheme that we have developed under ABF can be adopted at national level to domesticate the Kampala agenda into actionable tools that can leverage private investment into value chains. And we see this currently as a quite important tool that can contribute to the implementation of the overarching policy framework that Madame Foutabong in her previous reflection alluded to. And as funding under this matching grant fund will ultimately phase out, our work has further evolved since we met in the previous edition of the Expert Exchange on Access to Finance. In the meantime, we have initiated a dedicated investment readiness program for the MGF partners, and we're currently working closely with around 40 businesses across the continent to gradually get them investment ready through organizational capacity development and targeted coaching measures. And this is done with the goal of brokering partnerships with financial institutions and financial enablers later in the year. So, as you can see, this expert talk is truly coming at a suitable time for us as we move towards strategic matchmaking events planned later in the year. And as already mentioned by Madame Diop and Madame Foutabong today, we will look into findings derived from a recent study jointly commissioned by AUDA-NEPAD and ABF, looking at the operational performance of numerous agro-processors across the continent. And to cut a long story short, we will see that the capacity optimization that is needed poses an opportunity for further partnerships and to promote access to finance. And hopefully through the discussion today, we can identify some of these potential partnerships. With that, as I'm sure we're all keen to hear from the speakers, I would like to hand it back to you, Hamadi, and I would like to thank all the participants for being here with us today. Thank you.
No, thank you, Simon, for your insightful remark. I think the fundamental question we will be trying to address today is whether an agro-processor can obtain finance and still operate below capacity. We have been complaining over the last 2 decades, at least that I know in CAADP, about lack of finance, and now we're seeing agro-processors receiving funding and operating below capacity and not being to capitalize or fully utilize those funding. So let me invite Charles Mugai to walk us through the finding of the study that was conducted, the funding that was commissioned by the African Union Development Agency and ABF and walk us through the findings. So Charles, you have about 10 to 12 minutes to walk us through it for the sake of time. Thank you.
All right, thank you very much, Dr. Hamadi, the organizers, facilitators, and participants. My name is Charles Muigai from Mazao Pesa, and I was given this opportunity to conduct this study, and I'll share the findings from the report. I'm sure, is it visible to all?
Yeah.
Okay, excellent.
Can you put it on slide mode?
Is it better?
I see you see at the bottom. Okay, it's better now. Thank you. Go ahead.
Good. And this study was to capture what is the real situation of agro-processing in Africa in terms of what are the capacity situation and also the optimal performance of many of these agribusinesses. And
Oh, I think Charlie is having some difficulties. His sound just went off. Charles, can you hear us? Charles, if you are with us. Simon, can you check maybe from the computer point of view so that we can move on, because I think we're having problem with Charles. Okay, so maybe let's do this for the sake of time. I will maybe come back to Madam Fotabang, who is familiar with the study, maybe to give us a few pointers, and also maybe share with us what the finding of the study means for CAADP and for the agro processes and for the continent. But Madam, you want to come in?
Okay. Wow. Thank you, Dr. Job, and thank you the present for that insightful presentation. Can you hear me?
Yeah, we can hear you, but if you can put your video on also, that would be appreciated.
Yeah, because we are having this
Okay.
connectivity problem, but let me try. And but also, as I said, I'm just recovering from a cold. I don't want to be coughing, and you're hearing me coughing. I'm actually struggling to stay awake and be here with you people just because of the importance I attach to this webinar.
We appreciate it.
So yes, thank you for that insightful presentation. Now the findings I think reinforce a critical message, which is that improving capacity utilization in Africa's agro-processing sector is not simply an enterprise challenge, rather it is an ecosystem challenge. While firms can improve efficiencies and adapt new technologies, they cannot operate at full capacity without reliable raw material supplies or affordable finance or adequate infrastructure, efficient logistics, skilled labor, and competitive markets. This, I think, from the study, this points to three critical or three strategic priorities. The first is that finance must become catalytic rather than transactional. Investment should support the entire agro-industrial ecosystems, So from working capital and equipment modernization to storage, logistics, and technology, while also reducing risk that discourage private investment. The second strategic priority will be about strengthening agro-processing requires integrated value chains. So reliable farmer-processor linkages, modern infrastructure, quality standards, innovation, and skills development are all essential to improving productivity, reducing post-harvest losses, and increasing value addition. And thirdly, in terms of messages, that the CAADP Kampala Declaration provides the strategic framework for action. I think that's the key, very important message that we're trying to pass here. The true strategic objective 1 and 2 calls for accelerated agro-industrialization and increased investment as mutually reinforcing drivers of agri-food system transformation. So optimizing existing processing capacity is therefore not only an industrial objective, it is an investment strategy that improves returns, creates jobs, strengthens regional trade, and enhancing African competitiveness. The message from today's discussion is that capacity utilization cannot be improved by enterprises acting alone. It requires coordinated action by governments, financial institutions, the private sector, and development partners to remove systemic bottlenecks and crowding investments. So ultimately, the success of our investments will not be measured by the amount of finance mobilized, but by the extent to which that finance delivered productive enterprises, competitive value chains, decent jobs, and resilient agri-food systems. That is the vision of the CAADP Kampala Declaration, and it should guide our collective effort. And I think the study is really a good illustration of the actions that we need to do to help to have our small business operate in optimal capacity. So maybe I can stop here for now.
No, thank you very much. I think we take note of really those big three messages in terms of priorities: finance as a catalytic engine, strengthening agro-processing infrastructure, quality standard, and the like, and the Kampala as a strategic framework. Let me maybe invite Agatha Thuo and also get her perspective from the private sector. But Agatha, before you come in, I want to maybe put on the spot Shola, who is also a private sector specialist and who also is very familiar with the study. Maybe get his perspective very rapidly. As we have Mr. Charles Mugai, maybe he can fill in some of the issue that may have not been covered by Madam Fotabong. Shola, you want to come in?
Thank you, Dr. Diop. And I think we apologize that Charles dropped off. So I could speak to some of the slides, and my colleague Ashford will also support. I think the challenge we find ourselves in is a bit of a strange situation, because we are now in a position where we have installed capacity which is being underutilized. So this capacity has been installed because people have either gotten equity or they've gotten debt and the investment has gone in. And yet this investment is operating at 30 or even 40% of the capacity. And that is really what necessitated this study, to find out what are the key challenges that processors are having, which are leading to this. So when you look at financing from the banking perspective, where you want to collect, get debt, the agro-processor is almost seen as a safe bet because the risk factors there are manageable and they can be mitigated So attracting investment at that level is not particularly difficult. And yet the agro-processor has to depend on the supply chain, the smallholder farmers, the aggregations and the aggregators to get the volume of raw materials to these factories. And at that point, there is no financing, or there's limited financing on the backward side of the value chain. So the investment goes in, is operating at 30%. The raw materials are a challenge to obtain because financing is not on that, particularly with the producers. So the agro-processors then have a challenge that servicing this debt, which they got under the assumption that they could be operating at 70% capacity, they are now operating at 40%. So the banks then, of course, the challenge of default increases. The performance of those loans goes down. The returns in terms of payments periods becomes longer. And so we then find ourselves in a situation where if these agro-processors cannot obtain raw materials from the local supply chains, they are left with only one choice, and that is to import. And so part of the problem that we're having with the food import bill is because agro-processors are not operating at that capacity, and for them to sustain the operations, they just have to import some of the raw materials. So we're really in a situation where if we do not fix the supply chains, if we do not work on issues on production, productivity, aggregation, and the financing, then the performance of these processors will always be suboptimal. And that is really why we are here today. And that was the purpose of this study. And we've done this study in 4 countries, Malawi, Kenya, Ghana, as well as Nigeria. And the pattern is more or less the same. Apart from some of the big maize millers in Kenya, who are operating at maybe 70 to 80% capacity. And the reason behind that is clear. They get a lot of the maize from, say, the reserve agency. So there is a big national aggregator and they can get the maize from there. Those who are outside that system are struggling to get the raw materials. Those who are outside that system, I've also tried different methodologies from contract farming, and being anchor farmers, but the supply chain itself has got a lot of fragmentation. And that is one of the biggest risks that is there. So if we could get the value chains to be more integrated, both vertically as well as horizontally, then we have eliminated the big risk that will also allow financing to go further down the value chain. So that is, a top level analysis of what we have done. We looked at, I think, 25 agro-processors in various value chains. And that is the situation we are finding ourselves in. We have installed capacity, which is underutilized because the supply chains are not connected enough to support agro-processing to operate at an optimal level. So I also asked my colleague Ashford to also come in, and then we can hand it over back to you.
I'm the moderator. I'm the one who who
Okay.
give the. Let's hold on to Ashford for now. I would like to ask Miss Agatha after listening to you, because I think you have given the highlight of the report. So even if Charles cannot come back and make even a few comments, we get the gist of it. So and then also we have heard from the director, Madam Fatabong, also on the key messages. So let me invite Agatha. Agatha, you have heard a clear message. Finance must be accompanied by operational plan, reliable input, quality system, market access, and an enabling ecosystem, as Madam Fatabong has highlighted. Now, I would like to hear your perspective on what condition inside a business, for example, and across the ecosystem, that determine whether finance can become a stronger capacity utilization, because apparently finance is there, but the supply chain are not there. So let me hear your perspective on what you have heard from Madam Fotabong and from Shola.
Thank you very much, Mr. Hamadi, and the previous presenters. I think I also want to say that from a private sector perspective, I concur with the earlier sentiments and what has been presented. My name is Agatha Thuo from the Agriculture Sector Network, and the Agriculture Sector Network in Kenya is the umbrella apex body for private sector actors in Kenya. So within the network, we have associations like the Cereal Millers Association in Kenya. We have the Kenya Association of Manufacturers. We have the cereal growers, and a variety of many other value chain actors, including farm input suppliers that are working within the same value chains. I would have loved to listen to the entire presentation from Charles. It's just unfortunate that things went wrong. But thank you again from Mr. Chola for bringing out the content that is in the report. So I also want to say that from a private sector perspective, access to finance alone does not translate into agro-industrialization. For Kenya and for the African continent to sufficiently industrialize, we must look at the ecosystem. We must also look at it from the enterprise level and also from the ecosystem conditions. The conditions must be right, because we must focus on the entire supply chain, and I am in total agreement. For example, one of the key challenges that hurts the private sector and affects the private sector a lot. And I want to say that also, although in Kenya we have large-scale commercial millers that are operating at very high capacity, incidentally, we still have other small ones which are not even registered, sufficiently recognized as, operating officially, which is also quite dangerous, because we need a good environment for them to be able to really come out. And one of the reasons that sometimes they don't want to come out is because of the business environment. So, for example, within the business environment, when the levels of taxation are very, very unpredictable, that becomes one of the challenges. The business environment has to be right. For example, just giving an example of the levies, and this is a practical case in Kenya. It's something that we are working very closely with the government with. We have a cess in Kenya that demands that when produce is moving from county to county, then a particular amount of cess is supposed to be paid. And ultimately, if a miller is milling from the extreme side of the country, then you find that the cost of doing business becomes extremely high. And I want to say that the business environment has to be right, and the policies have also to be very, very predictable. At least for us in Kenya, that is one of the things that we are working with the government, that we need at least the policy and the policies and the taxation regimes to stay constant and to become predictable for a particular period of time. And that is very, very important. I think the other thing is the issue of efficient and reliable infrastructure. Infrastructure is a supportive, it's very supportive. The infrastructure has to be right and it has to be efficient. For example, electricity has to be reliable, and not just reliable, but also cost effective. And I have not done a lot of comparisons with the many countries in Africa, but definitely for us, for example, the cost of electricity is still relatively very, very high compared to the cost of electricity in the rest of the African continent. And I think that is something we need to deal with. And also possibly look at alternatives so that we can reduce the cost of doing business, because in business, competitiveness is very, very important. And the issue of good roads for our millers, for our processors to be able to move commodities from the farmers, roads are very, very important. But apart from that, we also need to make sure that our logistics are sufficiently efficient. For example, the cost of transport. And I think we are affected as an African continent. The cost of transport has just gone up, especially because of the Middle East crisis. The cost of petrol and fuel has gone up, but it also comes into play for us to be able to sufficiently industrialize. So we must look at, as an African continent, alternatives so that our processors can sufficiently support us to industrialize. We also need working and good, well-managed aggregation centers. And apart from the aggregation centers, we need to support our smallholder producers. In Kenya, 70% of the producers are smallholder. And we need to bring them into the value chain sufficiently. And therefore, we also need to employ technology. How do we support the smallholder for 70% smallholders to aggregate? And I think we need to employ technology. At this point in time, we cannot afford to be left behind as the African continent. The other one, we need to move our goods. And I really want to, I'm very happy and very proud about our African continent. We can now trade with each other, the Africa under the Africa Free Continental Trade Agreement. But are we really sufficiently doing that? Have we sufficiently opened our borders to be able to move produce from one country to the other? And for us to be able to industrialize, we need to open our borders so that we can do trade with each other. And I think we still have issues in some of the borders. I'm happy about the African Union. I'm happy about the COMESA. I think the last COMESA summit was held in Kenya, and the intention is to make sure that we facilitate trade within the COMESA countries. But we need...
Agatha, if I can ask you maybe 3 key messages from what you have heard that the private sector would like to see. I know you have highlighted the issue of infrastructure, you have highlighted the issue of the business environment, and you have highlighted the issue that we have to focus on the whole value chain. If you have 3 key messages to formulate, because in this session we have a lot of people who are from the private sector and who are listening, and maybe who are facing specific challenges. So are there 3 maybe key burning issues that you want to suggest in terms of solution, in terms of moving forward? I think the challenges that you have raised are almost similar to the one Shola has raised, and also that Madam Fotabong has highlighted. But in terms of solution and perspective, what would be your number 1, number 2, number 3 messages?
Yeah, maybe I will be biased because I'll be talking from a Kenyan experience, but thank you very much, Mr. Hamadi. I think the business environment is very, very important. The levels of taxation, the policies is very, very important to us as members of the private sector. That will definitely determine our competitiveness to be able to do business sufficiently. The other one is the cost of credit. And this one cuts across, I believe, the entire African continent. When you look at our smallholder farmers and how much they can be able to afford and the cost of production, I think our smallholder farmers need to be supported. And we need to look at issues of perhaps blended finance and supporting them with this insurance so that they can be able to sufficiently produce. In Kenya, we have a project that we work with together with the processors. We call it Agriculture for Industry. and production has to be market driven. And I think that is very, very important so that the producers and the farmers can produce for the market. Finally, the other thing that from an enterprise perspective, I think it is also important that businesses also position themselves to be able to move to the next level in terms of having strong business planning. That's important. The corporate governance within businesses is also important because financing alone, if, for example, the businesses are not business ready and sufficiently prepared, is not enough. We could very well finance businesses, and they don't work if we have challenges with the governance, we have challenges with the business planning, we have challenges with the access to markets. And I think that businesses also need to sufficiently position themselves to be able to access finance. Thank you.
No, thank you very much for those insightful suggestions. I think one of the things maybe that I can pick up to help us to transition to the panel is the issue of the cost of credit. I'm pleased to welcome Eric Picard, who is the Chief Strategy Officer at Access to Finance Rwanda. Eric, please help us move from the diagnostic to the deal. So which financial structure and instrument are best suited to equipment, upgrading, maintenance that we have heard, automation, storage, quality assurance, supply chain resilience? Maybe the instrument we are using are not the right one. And that's the reason why when we listen to what Shola was saying, the supply chain, you have a supply chain disruption, and then the whole processing value chain basically collapse because utilization of the resources are at 30 to 40%. So I just want to get your perspective on that one.
Thank you very much, Hamadi, and thank you all for all these remarks, presentations that I've made previously, and I think that will inform very strongly my response. I'd like to respond to this question, Hamadi, to pick up on some of the remarks that were made by Madame Tu and during the presentation as well. I suppose the constraint that we're seeing regarding a well-functioning agro-processing entity that is in fact in position to access financing, we see that the constraints has to do with what is happening essentially upstream along the value chain, and the fact that basically the inputs are not coming at a sufficiently high rate. I guess this positions the whole question of financing these entities. I guess it requires to do a little bit of a paradigm shift, if you'd like. Essentially, the challenge is that if we think of financing only at certain specific levels without necessarily thinking of financing throughout the value chain and at the systemic level, we end up finding ourselves in such troublesome situations. Basically, we find ourselves in a situation whereby you have an agro-processor that is well financed, that has been in position to purchase equipment that allows it to process at a certain level. The inputs do not come at a sufficient rate, but why? And I think the response has been pointed out by Madame Tu and some others. The fact is that we still have a situation whereby the smallholder farmers, which are the main providers of input, are still constrained in terms of their productivity and their capacity to aggregate and channel. We still have a situation whereby international trade and importing might be the solution. The constraints related to basically intra-African trade still become a constraint. So this points essentially to two things. In terms of instruments that may be the most relevant given this situation, I suppose we have to go back to the support that can be provided to smallholder farmers from a financing standpoint, and this essentially has to do with working with microfinance institutions and banks, and seeing how those can essentially serve better those markets. I work with Access to Finance Rwanda, which is part of the finance sector deepening network, covering a number of countries, 10 mostly it's in Eastern Africa and Nigeria. And a lot of the work we do is essentially to address these kinds of issues, has to do with working with not only the smallholder farmers themselves, but also working with the financial sector. It is important essentially to support the financial sector to be able to learn how to serve some of those markets that are perceived as very risky. Financing from a bank, say, goes very easily to an agro-processor. It has track records, it has an operations that is functioning, it has assets, etc., which makes it an easy target to when you have to provide a loan. This is not the case when you speak about smallholder farmers. And these need also to access finance. They need to essentially financial institutions need to design products that are that are dedicated to them, and that factor in what are their specific needs. Not only that, but also that factor in the risk that they represent. So what we do in supporting financial institutions to achieve that is basically to provide the whole package that goes from product design, human-centered to the extent possible, capacity building to the financial institutions to learn how to serve those markets and to be able to read up adequately how the market dynamics in those sectors. And when it comes to, I think somebody mentioned blended finance, and this is very critical because we have to highly leverage instruments such as guarantee schemes to actually make it so that the banks are not too reluctant to serve those markets. In an ideal situation, what you have is that over time, because their loss is covered and they have developed products that are adequate to serve those markets, the banks and the financial institutions are in position to learn how to serve those markets, and increasingly so without the need for de-risking.
Eric, if I may ask you maybe a more pragmatic question. You have been working in this space for quite some time, and also you have been dealing with a lot of institution maybe or agro-processing companies that may have been in the same situation as the one that has been depicted by the previous speakers. Can you share maybe a very specific, let's say, example? Let's say I'm an agro-processor. I'm in Nigeria, and Nigeria is a country that you are covering, and then I'm underperforming, and you are called, for example, to come and to support me. What are the ABCD that the agro-processing plan need to be doing so that they can benefit from the financing instrument that you have? Because we have a lot of people who are connected and who are really looking for practical solutions because they are experiencing the same similar situation as we are discussing now. So is there an ABCD process that someone has to follow to benefit from those instruments? And what would be those instruments? If I go to a bank now, I want to benefit. What should I ask the bank? What kind of in the continent for many years we have what we call the Agriculture Development Bank, but all those agricultural development banks are acting now as a commercial bank, and it has raised the cost of the borrowing, as Agatha was saying. What can an agri-processing plant do to be able to capitalize on it and also be able to bring, instead of operating at 40%, operate at 70%, as Shola indicated in his submission?
Thank you very much, Hamadi. I guess the answer to a very large extent is a policy one and a development intervention one. But if we are to focus specifically at the level of the agro-processing firm, basically obtaining finance at better terms and better cost is related by and large to being able to provide the right documentation to demonstrate that they have access to a market that is viable, to demonstrate that they have an asset base that allows them to cover for potential risks that they can take on. to demonstrate that they have off-takers that can ensure that they have sufficient revenues, to demonstrate that potentially they have insurance and that can cover potential losses. So all those aspects are very much related to some points that were already made. Governance is also something that is often neglected, but when you reach a certain site, it's important to be able to demonstrate that you have adequate governance systems within your corporation to ensure that you're not risky and your management system are actually sufficient to function well. So this is essentially what I would say, but you can only go so far. Really, I would like to come back to the fact that an intervention, decreasing the cost of financing means demonstrating a better operational efficiency, and we have seen from the report that this is related to systemic challenges, especially those related to inputs and what happens at the level of inputs provider that really need to be supported.
No, thank you. I'll come back to you for a follow-up question later on. But we have heard from you as a financier. But now let's go listen to someone who is in the business of agro-processing. Let me invite maybe Sini Samba, who is a co-founder and chief executive officer of the Lionceau. Sini, please share the enterprise perspective. How can a growing agro-processor use finance to improve production regularity? And also, if you can share also maybe some practical cases in your situation where you producing a lot of commodity for babies, I'm assuming. So if you can basically share maybe a few perspectives on that one. Sini, you have the floor.
All right, thank you so much, Dr. Diop. I'm very happy to be here. So our company is called Lionceau, and we are focusing on nutrition by manufacturing locally sourced and produced baby food in collaboration with smallholder farmers, women's group, and to bring to babies products that are with high quality and nutritional value. So for us, the problem is when you have capacity, when you are a growing company, you have demand, you have potential, but needs the right financing to produce at a regular and higher quality. So for us, it's very important. It's not only about, having a machine or a loan. The challenge is how are we going to synchronize several things along the food systems, but at the same time. For example, regarding the raw material, when you are working on, the mango field, you know that it's a very seasonal raw material. So you need, when it is a season, to have the right financial. You have the amount of the fund that you need to buy all your mangoes that you will need for the year that is coming. And usually what is happening for most of agro-processing companies, sometimes they don't have access to fund the seasonal raw materials, and then they will only buy what they were able to buy at that moment. And of course, you can imagine that later on, you will have you can have the quantity of mango that you buy in Senegal, for instance. The mango is starting from May. So from May to July, you will buy great mangoes. And if you don't have enough fund that you need, you will only supply yourself from mango to December. And then after that means from January to the later May, you will be almost out of stock to your product that contain mangoes. And it's not only about, having the fund, it's also having the infrastructure, the code room to be able to keep and storage these mangoes all along the year and make your product the more accessible possible. So it's very important to see, how can we have access to this fund, but especially at the right time, and have the reflection more in a more ecosystemic way, knowing that if one thing is missing, it might have impact all in the whole food systems, and your operation are not going to be very regular.
No, thank you. I think your contribution underlines that finance becomes productive only when it is aligned with an enterprise operating rhythm,
Absolutely.
procurement cycles, quality requirement, and market opportunity. I think this is precisely really the bridge we need to build between finance and performance. Let me maybe look at also invite another maybe panelist who is working day in day out with the agro processors and along the value chain. Daniel Anerose is the chief executive officer of a company called Accelerant. Daniel, from your work with processor, suppliers, and financial institutions, can you share your perspective on what keep processing plant below capacity? Because that's what we have hearing, and also which investment tend to bring the fastest practical gain in terms of optimization.
Thank you very much, Amadi. Can you hear me well?
Yes, we can hear you. You
Excellent.
can also speak in French if you want, because we have interpretation in both languages.
As you want. I mean, okay. So, but let me start in English, and if you can understand what I'm saying, just let me know. I will come back in French. So basically,
Good enough.
it's a company which is orchestrating infrastructure that make African value chain bankable, mobilizing capital to finance the entire value chain, orchestrate it as a new class of assets attractive for private sector. Okay, so I come back to what everybody said before. We are in a very particular situation, finally, that you all know. What is the situation? Less than 4% of the total credit allocated by commercial banks goes to the agricultural sector. It is like if we have hundreds of millions of people in this continent, and they are almost invisible for a bank sector. And the reason why we are in such situation is because banks see many complication issues in financing agriculture. We can talk about smallholder farmers. Yes, this is probably the segment which is the most affected among the value chain, and we can go upstream and downstream. We will find the same reason, and that makes Africa, and particularly sub-Saharan Africa, part of the continent which is one of the biggest importer of food. Even we have land, we have resources, and we have water. And this is why we try now to find ways to mobilize the private sector to finance at scale agriculture. And we are not looking particularly agri-processor or farmers. We are looking at the value chain. We cannot continue to figure out that we will be able to finance a particular segment of this value chain without looking how this value chain from the upstream segment to the downstream segment could be profitable and could be de-risked. That's the point. As an agri-processor, many previous colleagues mentioned it before. As an agri-processor, it's important to secure my supply chain. As a farmer, it's important for me to get my credit on time, to get my inputs on time in order to secure my production capacity. As an input supplier and seed supplier, it's important for me to be able to optimize my distribution channel toward these farmers. And this is our strategy, is really to organize this chain every cropping season, campaign by campaign, to be sure that the risk due to an underperformance of one of the actors into the value chain, but also the risk due to some friction within the interaction between the different value chains actors is managed, is anticipated, can be controlled, and before it becomes a crisis can be managed properly. So that's what makes a private sector interesting in financing value chain. It's better to come with what we are doing. We are coming with 5 years cropping, a plan of cropping season, 5 years, no less. We know exactly what we want to do. We consider the kind of risk that we can face. We mitigate this risk. We take some measures to mitigate this risk, and we come with a project, a 5-year project to be financed, including all the actors of the value chain. And the point is that we have to consider the different category of risk, and there are many risks into this business. Recently, the crisis in between Iran and USA and Israel just showed that there is one conclusion which comes that 2 routes, maritime routes, can affect the global food security. So the vision is that we have to support the development of the production capacity in the producing countries. We have to bring capital to finance the working capital and to finance the modernization of this value chain, which implies that we say our private partners, guys, this is a plan for you to invest, and this is a plan in this value chain. If you invest in the working capital, this is a return on investment you will get. If you invest in the mechanization, you invest in the infrastructure, this will be the return on investment that you will have. And this is how we can mobilize blended finance around this project. I think we have to shift to this way of looking at how we can finance agriculture, not to stay focused on one segment, and come with a very comprehensive plan describing the strategy, describing the risk, describing the mitigation that we are capable to address. We cannot do that without technology. I agree with what one of our colleagues said before. We need technology. We need to train farmers. We need to train banks also to accept that, how to finance farmers. Many banks don't know how to do that. We have to train insurance companies. So it's a package that has to be designed to support the improvement of performance of the value chain. And this is what we are doing currently. Currently, I'm in the UAE, so I'm working with the private sector. You know, the capital is there, but they don't have land and resources. And I'm trying to explain them that it is interesting, it is profitable to invest in supporting African value chain, modernize this value chain, support smaller farmers, not only look at segment by segment, but the value chain, and do it in a non-extractive way, which is also very important.
No,
I stay
thank you.
there. I don't want to be too long, but I think this is the way we have to shift right now if we want to create this added value, which is absolutely required in order to make our
no, thank you very much, Daniel. I learned a lot from your submission, but I am sure later on Madam Fortabong will come to it. Before, when we talked about the agriculture investment programs at the country level, it looks like a list of a wishful intention. But the new CAADP Kampala is shifting the narrative to developing what they call bankable projects and bankable initiatives that speak to the private sector, with the strategic objective number one, as Mrs. Fortabong said in her opening remarks. The strategy objective number one is really focusing on productivity, agro-industrialization, and trade. And the issue of agro-industrialization is very big. The second also issue that you mentioned, where externalities are impacting our value chain, is very important. I was reviewing recently some of the work that is being done within the ECOWAS region. They import a lot of urea that is being utilized in doing fertilizers. So the urea price, because of the Middle East crisis, spiked by 58%. And all of a sudden, this translated into more than $1 billion in the food import bill for just the ECOWAS region. So I agree with you that in terms of thinking, in terms of mind shift, we need really to bring the issue back to the continent and develop really more resilient value chain. Maybe I will ask you a question, but I just want you to think through. I'll come back to you. In the continent, based on all the discussion that, all the submission I have heard so far, we're talking a lot about what we call the missing middle. So the micro and the medium small enterprises. We have a bunch of them in the continent. We're not talking about the big basically enterprises, but we're talking about the micro and the micro and the medium smallholder enterprises, and that's where really we need to do it. How can we? I just want you to think through it, since you work on the value chain. How can we strengthen them along a certain number of value chain so that they can be more competitive? Because the big one, we can discuss at length about it. They are maybe more resilient, but the little one that we have here, and I have seen some people from the chat saying that, okay, I have a land, I need some investors, etc., etc. So let me transition now to invite Maggie Mutesi, who is also a colleague of mine and who has been monitoring the chat, and then see whether there are maybe a few issues that are emerging from the chat that warrant maybe our interest from the panelists. Maggie, you want to take the floor and.
I'm trying to unmute myself and just also add to Spotlight. I think I've seen a few questions coming in. Like you've mentioned, of course, we have like Procedure Robert, who says, what is the easiest and practical way to link farmers to financial institutions? And this question has been sent, I think, about 3 times in the chat. We also have a question from Ramona Navi, who directed this to Simon, and they say, would you be able to share more about how ABF supports agri-SMEs growth and the matching grant scheme you mentioned briefly? So most of the chat is really around also participants linking some of the panelists' insights to, what they're doing. For example, someone mentioned, I'm from Sierra Leone, and my company has a vast portion of land, and we are currently investing in cocoa, pineapple, pepper, onions, maize, everything. But we're having challenges with funds and partnerships. Perhaps panelists could also speak briefly to that. Those are some of the sentiments we're having in the chat and on the Q&A. Dr. Amadi, I'm not sure if you want to prompt some of the panelists to answer to them.
No, thank you. But before we do that, I think what I want to do, since Charles is not here, I will ask Ashford to come in, but not to show any presentation for now because Charles is not here, but just to tell us, based on the finding of the study, what are the 3 most binding causes of low capacity utilization among agro-processor, and which of these can enterprises address most immediately? I just want to be now more solution oriented. I think Shola has given us a perspective, but I want also Ashford to start giving into the solutions. So what are the 3 constraints, and what are maybe 3 key solutions from your perspective before we move forward?
Yeah, thank you, Hamadi. Ladies and gentlemen, I'll just go straight to the point. There was quite a number of issues that came out from the different questions, and among the top key, I would talk of 4. There was this low material supply, which is more of talking about as being the dominant driver of the capacity and requires these working capital solutions. The energy cost infrastructure gaps, which also contributes to raising the operating risks and financing costs. And if I tie that to the quality and the price volatility, then apart from the raw material, which is more on the productivity, more on the supply chain management, we are talking about the governance ecosystem as a second and key issue, tying around governance, policy, and management, the governance structure in the different contexts, be it at national, regional, or even maybe at the local level. last but not least, as you asked about 3, is the finance. The finance itself, and it's not only the availability of finance. From the previous discussion, there was somebody who alluded to the missing middle, is that either the finances are available in large chunks, and the administrative cost of disbursing the different small ticket price sizes becomes an issue from the different financing institutions. So finance access into it, and the right kind of finance, and of course that ties in with other details with regard to repayment period, with regard to collaterals, with regard to talking about agro-processing, and what is the lag period would you wait for you to be able to repay. What are the what we foresee as some of the expected solutions is when you're looking at the supply chain, it's more increasing the capacity. And in the long term, what we may have seen from the study is some of the big companies or institutions are joining ventures or merging. Then the second one, which I talked about, energy price volatility. We are talking about product competition. We are talking about policy uncertainties and sometimes not talking to each other. This ties around looking at the governance structure and having a homogeneous, if not a seamless kind of policy rules and regulations across countries.
No,
and then
thank you.
the last one on financing is actually packaging the right kind of finances and accessing the finance, looking at these listing methods for these companies to be able to access the right kind of credits or finances that they may require. Okay. So in a nutshell, that's what I would talk about in terms of from the findings of the study. Yeah.
No, thank you. I think I take three messages: access to input, finance cost, and governance ecosystem. So this will help us maybe to get back to our panelists. There is a question that was addressed particularly to Simon. I know Simon is not a panelist, but Simon, you want to react to it? It's a question on people want to know more about basically the ABF and how to link finance to agro-processors.
No, thanks a lot. It's my pleasure to come in here on some of the discussions points. Very interesting discussion so far. I maybe want to answer to this by saying that from the Agribusiness Facility for Africa point of view, we look at specific aspects of the ecosystem, recalling the initial discussion that was raised on finance only working out for the whole value chain if the entire ecosystem is in the right place and if the different segments play well together. And I think Agatha, she shared already a lot regarding the infrastructure situation in Kenya. And looking at our experience with the various MGF partners under the matching grant fund that we work with the agribusinesses, I want to put it more on the micro and meso level of the value chain. So the value chain operators themselves and the technical and financial support functions that enable them. And our experience under this matching grant fund is that we have been able to compile a compendium of best practices, as we call them. These are tools and methodologies that apply all across the value chains, across the different levels of the value chain, and have proven to work well for agribusinesses and enable them to scale their working models. And many of these tools in the livestock, maize, and cocoa value chains are dealing with the issue of value chain integration. Yeah, remember that we had this discussion about the value chains often not being sufficiently integrated for the processors to be able to get their hands on the volume that they need. And I think based on this compendium that we're currently compiling, a few issues emerge. One is around the value of digital innovation to drive integration. So think about digital market platforms that increase transparency for different segments of the value chain and that allow an aggregator in the value chain to have the planning horizon and the level of information that they need. So digital innovation is critical here. Also for the suppliers themselves to know where the market opportunities are, which prices they can get, and for them to also feel confident that they can supply effectively to a certain off-taker. And then as
maybe
one
just
of
maybe just
yeah.
a quick one, because people are basically asking maybe some practical question. How does a company qualify for the ABF support? For example, you indicated earlier that you have supported about 60 plus agro-processing companies in the continent in specific value chain. What are the ABCD someone need to do to link to benefit from you if it's still open, and what is the process? Maybe that may be useful also to some of the listeners.
The process under this matching grant fund is closed for now. So we have come to a stage where we have selected 65 consortia, but I would still like to share here some lessons in that sense, because as I presented earlier, we have been talking also to stakeholders in Kenya to adopt this tool. And I think a competitive matching grant fund can always be set up in a way that you set eligibility criteria such that, for example, a challenge that you observe in a particular value chain, such as a lack of integration, can be addressed. So you can make the criterion of different players in the value chain to come up with a strong proposition on how they will collaborate in a more integrated way as one of the key criteria for your selection process. So I think, as much as you provide funding, it can also be a way to shape the value chain and to have a certain contribution for it to develop in a certain direction that you see. So some of the projects that we have supported have been doing exactly that. They have come up with strong consortia all along the value chain to drive integration. And we see this now working well, with digital innovation sometimes coming in, with contract farming sometimes coming in. And as we will go ahead and share some of these experiences through success stories, through the best practice web portal that we're developing, I hope that others can also benefit. And then hopefully funding windows will always emerge, be it at national level or Pan-African level. But I think we also need the right technical knowledge to accompany that. I think that has become clear from the discussion.
No, thank you. Thank you very much. You mentioned compendium of best practices, scale working model. Can this be shared with the panelists? Can someone maybe post maybe a link to it to the chat box? Let me go back maybe to Daniel and Rose. I think there is a good transition between what you just said and also what Daniel is bringing to the discussion. Daniel, can you share with us? I think that's the question that many have asked from the chat. Can you share with us how we can link processors, suppliers, and financial institutions, and how does better operational data on value chain change what financials are willing to do? So just in few minutes.
I think, first of all, I may come back to your question as well. You asked me previously about the small and medium enterprises, how they could be financed. What is the story today? Today, if you go to a bank, and one of the colleagues from Rwanda mentions that, they will ask the farmer for guarantees, for bank history, balance, etc., P&L. Most of the smaller farmers and the medium and small enterprises in Africa, they are not the best to provide that kind of documentation. And we know that. So what we do, instead of telling the bank, listen, this farmer is looking, or this small and medium enterprise is looking for credit, we come with the project, and the project is a cropping season, and we organize this cropping season in a way we say to the bank, this is not the farmers that you are going to finance. You are going to finance the project. And the project is a cropping season, as I defined it previously. So how it works, basically, first of all, you need to have a complete mapping and profiling of the actors in the value chain. And it's complicated. It's not only having farmers, It's only every individual infrastructure has to be mapped, equipped with IoT system. You have to go to use the technology in order to have a clear knowledge of what's going on the ground. And you can use many, many technology to do that. All of the technology available, including artificial intelligence. Then the second pillar, and this pillar, there are three pillars, right? So this is the first one, mapping, profiling of the value chain. The second pillar is the coordination of the value chain. And this is a business. I mean, I call it orchestration, but the way you organize the actors to work together in order to be agreed to deliver the best they can to make the value chain, the cropping season successful, including the banks. And the third one is to have a physical presence on the ground. We are talking about creating job for youth, for women, but this is for us. We have an accelerated academy. We are creating jobs. Every cropping season, we have youth trained by our academy to assist the farmers, to collect data. So these three pillars, the mapping, the profiling, the capacity to organize, to orchestrate the chain, and the presence on the ground are working together tightly, efficiently. It's very important. Then when you have that, then you can come and go to the bank. When you're sure you can manage that kind of organization, you can orchestrate it at scale, then you can go to the bank. And you are not selling the individual, presenting the individual actor into the chain, but you're presenting the project. What is the project? Is to say, you know, I have to produce over the next 5 years 600 tons of paddy rice. In order to do that, I always have contracts with with 5 rice millers, and these 5 rice millers, they already have contract with some distributors. All of this is in the table, not contract, but we call that service level agreements, right? On the other side, we have 50,000 of hectares that will be progressively financed in order to produce enough paddy for this rice miller to produce. And everybody is under contract. That's it. And it works. And you as a bank, you can monitor, you can trace every activity. We have a cash discipline. There is no cash which is going out of the system. Everything is controlled. That makes banks much more comfortable. It takes time for them to adopt it. But by the way, for private investor to attract private capital, it's a very, very powerful way to proceed. And you can bring private capital, put it in the bank, working together with the bank in order to finance more efficiently and at scale a larger number of farmers and smaller.
Okay, so you're talking about aggregation,
yes,
contract farming,
aggregation,
contract farming, and
transparency
all together,
and discipline.
Okay, all together.
All together, including training, and you have to put training. You have, I mean, this is not. You have to train everybody in the chain, including the insurance company. But all of that is coming together.
Okay, let me see maybe if Eric has maybe some point of view to complement what you just said. Eric, you want to come in and maybe give your point of view on what just Mr. Aneloro's mentioned.
Thank you very much, Amadi, and thank you, Daniel, for these remarks. I guess this echoes some of what you observe also at our level. Essentially, the mismatch is one of information asymmetry. Some of the work we do aims specifically at that. I mean, there are various instruments that can be used, ranging from contract farming, better integration of value chains, digitalization, and so on and so forth. And I want to very much agree with what Daniel is indicating. Basically, the structuring of financing at a different scale, if you'd like, at the level of a value chain and in an integrated fashion that covers a longer time span than just a year or a season, that that is structured as a project with clear returns that would be built in and clear impact that would be built in. Essentially, all of that can contribute to decrease information asymmetries between the supply side of the financing ecosystem and the demand side of the financing ecosystem. And this is very, very critical.
Eric, I just want you also to reflect on one thing. If I am a mid-sized agro-processor, how often agro-processors come to you in your function to request for financing? And how often you look at the risk, whether the risk of high or whether the cost and effort of assessing the transaction outweigh the return to the lender? Because those are the decision issues that you have that may impact basically also the process. Or do you look at all the issues that just Daniel mentioned in terms of the entire ecosystem, whether the whole value chain is integrated or not? Or do you look at the things individually and assess the risk differently?
Sorry, I have to go. Excuse me, I have to go because I have another meeting. But I will get the conclusion of this meeting. Thank you.
No,
for
that's fine.
all of that.
We appreciate it. We're closing in a few minutes anyway, but thank you very much for your contributions.
Yeah.
Bye. Okay, Eric, you want to react to it before I go back to Sini, Samba, and...
No, very quickly, if I may just point, if we were to look at individual firms, the way we have structured our program, essentially above and beyond what can be done at a more ecosystem level, is to not just provide the financing. There's a package. It comes with business development services. It comes with technical assistance. It comes with some level of even hand-holding, if I may put it that way, to accompany over a certain period of time an agro-processor that would seek our support to get to a point where they can engage with the financial institution on good terms. And that is very critical. Unfortunately, I don't have an answer for you that would say, okay, this package or this basically formula is a one-size-fits-all. Unfortunately, what we observe is that there is, generally speaking, a need for a strong accompaniment at the level of the individual firm and for interventions that go beyond the individual firm itself and touches on supply side, demand side, and enabling environment.
Okay, let me maybe go back to Sini Samba and ask her maybe a few practical questions because she is on the ground. She gets her hand dirty, as we say, as an agro processor. So, Sini, which financing term and non-financial support services make the greatest difference for a growing agro processor? So, what are the different things based on your experience that really have made a difference in terms of growing your company?
Okay, for me, the most useful financing is to make it patient enough for investment, flexible enough for operation, and practical enough to match the realities of agro-businesses. And in a very concrete way, it's, I'm just echoing the blended finance that the previous speakers were talking about. The first point is the equity part. In Africa, there are a lot of SMEs, a lot of small companies, and they are struggling to scale their business. And in general, they are lacking of some equipment. And when you said equipment, it's equity. You need to increase your assets, have strong equity. And for that, it's important to review the collaborations with impact investors or different type of investors to see what are the terms, the governance, to be sure that we are not really we are going on the way of the entrepreneur and sharing the same vision. So it's very important to have equity that is added to the entrepreneur and especially the stage of entrepreneur. So the second part is the cash flow. In cash flow, you need loans because when you are in the agri-processing, you are dealing with
Your your
raw
your your, your
material.
mic is really crashing. I don't know what's going on your end.
Oh,
Okay, now
sorry.
it's
Is
better.
it better
Go ahead. Now
now?
it's better. No, go ahead. Now it's
Okay.
better.
So the second part is the cash flow. So when you say cash flow, that means you need loans. And the time should be also great, especially when it comes to the interest rate. So you are doing raw material, you need packaging. Sometimes you're buying containers of packaging. That means you are going to make economies of scale. So you need to have this loan to buy at the right moment. And the third one, it is a grant. Because when you are on the food stamps, there is different capacity building.
Sini, excuse me to interrupt you a little bit. I think I'm not sure whether it's just on my end, but your mic is really crashing, and people are having difficulty really to hear you. Can you all hear Sini? If I may ask you, I just want to
Now
cross check
I
with
can
this
hear
on my
you,
end.
but
Okay, I think there is a
I
problem
can
with
hear you.
the.
But
You can hear me well.
I think
yes.
she's on and off. It's but we can try again one more time, perhaps. And
Okay, go ahead. Let's try one more time.
Okay. Can you hear me now?
Yeah, go ahead, continue your thought, and then we'll see.
Okay, I've just stopped the video. Maybe it can help. So I was saying the third one is the grants,
Better, yeah.
because when you are working on the food systems, there are different capacity building, with smallholder farmers. If you are supplying 100% locally, the raw materials, the supply chains should follow your production capacity. So it's important to have some grants that can help to strengthen smallholder farmers' capacity. And regarding what Simon was saying, my company has benefits about the Agribusiness Facility, and it was very catalytic for us because we use it especially to train women's group who are working along the food systems for us. So they are processing maize and different African traditional crops. So we train them through this grants line, and it was very good because we are not going to use a loan from bank to say to bank, oh, we are using your loan because we are going to train smallholder farmers and women group. So that means it's important to think about, the different actors. How can they have a intervention that can really help to address the scaling of agro-processing?
Oh, thank you very much. Let me maybe ask Maggie to come back again and see whether there are maybe one or two burning questions from the chat before we move into closing. We still have 14 minutes and we need to be closing. Maggie, is there any 2, 3, 4 burning issues that are from the chat that you want to share?
yes, I will just look through again. We actually have a lot of questions. I know a few of them have been addressed and some of them have not. There's a question to Eric. I'm not sure if Dr. Amadi, you are taking that. It says when financing does not happen for a mid-sized agro-processor, how often is it because the risk is genuinely too high versus because the costs and efforts of assessing the transaction outweigh the return for the lender? And what would change?
That one has been already
That one has
addressed.
been answered. Okay.
Yeah.
Perhaps maybe I feel like it's flowing again. There's another question that says that goes to all participants, rather all panelists. If the barrier is as much the cost of connecting capital to good projects as the capital itself, where is the highest leverage place to reduce that cost over the next 12 months? I'm not sure who that could go to.
Issue of cost. Okay, this one maybe Eric can address it, but those are the two major ones that are coming out of the chat.
Yes, for now.
Okay.
There's another one that says, how is risk assessed in conflict zones and how can farmers still benefit from financial supports in regions such as the Sahel? And I'm
This
not
one is
sure,
good one.
this is from participants. They haven't addressed it to anyone, but perhaps we could figure out who could take that too.
Okay, how do we assess finance in risk zone and
In
how
risk zones, and he's giving an example of the Sahel.
and the example of the Sahel? I'm not sure. Eric, you want to take that one since you are from the finance? You have one on the risk issue, and then the other one is on the cost of borrowing. I think we have discussed at length on the cost of borrowing again and again and again. But if you want to give your final thought on those two issues before we move to closing.
Thank you very much, Amadi. I'm not sure I captured the question of on cost of borrowing fully, but maybe let me start on the aspect related to conflict zones. Look, in those situations regarding conflict zones, again, I do not think there is any real silver bullet or magic formula here. However, while the market may be heavily constrained in terms of financing, providing financing in such contexts, typically you would have a significant availability of resources from humanitarian relief, basically interventions, and it's important to try to stay aware of such facilities and such mechanisms and such programs, so that they can contribute to essentially provide what can be provided in such context. On the cost of borrowing, maybe generally speaking, and relating to that, it's hard to basically provide financing in a commercial context in a conflict zone because the risk is too high. And risk is essentially the main driver of cost above and beyond the structural challenges that may exist. Risk now can be of two natures. There is real risk, such as in conflict situation, and there is perceived risk. And a lot of financial providers, unfortunately, determine their lending rates based on perceived risks because they don't have sufficient information to price the risk adequately. Many interventions, including basically structurally and in and of itself the nature of blended finance mechanisms, aims at addressing this perceived risk and basically teach the financial service provider to get to a point where they can basically assess that risk and have a sense of it that is closer to reality than just perception, by taking on some of the risk initially as the financial service providers learn. I hope this sort of gives some sense of
No. Thank you very much, Eric.
Thank you.
And I think you got us where we wanted to be. Let's now let me maybe share a few thoughts before I invite our August guest to come and close the meeting. So I think we went through all the constraints that prevent our MSMEs and our agro processors to optimize their operations. But what is coming clear out of the conversation is financing, as Madam Potterbong put in her opening remark, should be seen as a catalytic engine. But by itself, financing is not enough. If it is not supported, by a corporate governance and also with the business enabling environment, as Madam Thuo mentioned. So the other key messages that are emerging from the conversation is like agro-processors, agro-industrialization should be seen in general. It requires an ecosystem, and that ecosystem will look at integration of value chain and everything that deal with it. So if we don't look at it that way, we may continue to support fragmentation and support and optimization of different practices. And I think what Daniel shared with us before he left in terms of aggregation, in terms of support, would be maybe something that need to be further looked at. The last one is that the issue of the framework, and I think at the beginning, the opening panel indicated that CAADP could be a big framework, but its success will be measured not by the volume of financing mobilized, but by the overall ability to strengthen agro-processing and create jobs. And I think this very, very clearly. I think another issue that maybe that just came into the discussion, but not as a very strong standalone message, is that smallholder farmers remain the largest producers in the continent and require increased support in terms of finance, market, and technology. So these are the four basically overall messages I am taking from here. So let me invite Madame Fotabong to come and maybe share with us her final thought and also her closing remark.
Thanks, Dr.
Fotabong,
Diop. I can hear you. Sorry. Let me see. You want to see me?
You're still standing up.
I'm still standing up, barely standing up. Thank you so much. This has been such a rich conversation. And you have already done an excellent summary of the key findings or of the key points coming out of our meeting. So I really will be quick just to say really I want to appreciate everyone and that today's discussion really from the very practical points and experience that have been shared by the panelists, it's just a stark reminder that that finance is really not the destination, right? It is the catalyst. We're not looking for finance for itself, but it's to help to oil the wheels. I mean, and to make things happen, to get the smallholder producers be optimal. So it's that we can overemphasize that catalytic role that it plays, and therefore the real measurement of success is whether investment translates into higher productivity, stronger value chains, greater competitiveness, and more resilient agri-food systems. That's the end result that we are looking for, but this will not happen. I think the whole point of this conversation today was to highlight the critical role, that finance plays in this ecosystem, and we've seen that. So within the context of Kampala, we really want to get to a space where, this measures into actual investments that drive growth and strengthen value chains. And of course, achieving this will require, as we've heard, all hands on deck. We need coordinated actions by governments, creating the right, enabling environment, the right policies that will facilitate financial flows. We need financial institutions that have packages that not only cater to those big, companies, which is where some of the challenges have been. We need the private sector and the development partners. So bringing all this together where we can have, blended financing that helps to de-risk, investments. These are all critical messages that have been coming through. So really together, we must ensure that every investment delivers measurable impact for African farmers and businesses and African economies. The conversation today have been very encouraging, and together AUD and NEPAD and all the partners who jointly organized this important webinar, I think we'll continue the conversation and see how collectively we work with member states to deliver on the objectives of CAADP Kampala with regard to strategic objective 1 and 2. So we thank you for this excellent presentation, and I hope and look forward to many more of these discussions where we can share our experiences and propose solutions to unblocking financing for businesses, agri-finance, and agro-industrial development of the continent. So thank you so much for this opportunity.
Thank you,
back to
Madam.
Hamadi.
No, thank you, Madam Director, for your closing remark. Let me invite Simon to also come and share maybe few closing remarks. Simon,
Sure.
if still.
I'll be brief. I think Madame Vodabong said it very well already. I think we witness how knowledge and partnership empowers people and institutions to drive transformation. And that is why these exchanges are so fundamental, the one that we had today. And I would, of course, also like to extend my appreciation to the speakers and the panelists that have shared their expertise today. Maybe just a quick remark on cost of capital. To me, the question is that really the central issue? I do not think so. I think there's another opportunity cost, and that is that projects and business models that are working well are not getting the right visibility and awareness that they deserve. And I think that's something we can work jointly together on to present these cases well, to package them well. And then I think ultimately the cost of borrowing will also come down at some point. And as stated earlier, we have some investment readiness work ongoing with MGF partners of ours. And later in the year, we really want to help them present their work in Agribusiness flagship events, also in partnership with AUDA-NEPAD. And I think that's the direction for us to take, to build the enabling environment for businesses to present the good work that they do. And with that, yeah, I would, of course, also like to thank AUDA-NEPAD and AfriCatalyst for co-organizing this strategic event with us and the continued partnership. Thank you.
No, thank you, Simon. I will invite now my sister, Mariam Diop, who is the Deputy CEO of AfriCatalyst, to provide the closing remarks and also to close the meeting. But before that, let me take the opportunity to thank the team that has worked tirelessly into the organization of this. We had a wonderful group, including people from AUDA-NEPAD, the GIZ, and the AABF facility. Great team from the Shemba Center and the Zero Hunger Coalition, and also excellent work from AfriCatalyst team. So it was really a joint collaboration. So we enjoyed really organizing this together. So we have another upcoming webinar in September. I hope all of you will be available to attend. So with that, let me thank also all the interpreters and everybody who has been working behind in supporting the organization of the event. With that, let me invite now Mariam to give her the remark and also to close the meeting. Mariam, you have the floor.
Thank you very much to you, excellent moderator, Dr. Hamadi Diop. It's always a pleasure working alongside with you, and a big thank you to all of our partners as well, with whom without their contribution, we would not have been able to have such a rich discussion today, and concrete actions and concrete recommendation and actions that we're moving forward with. I would say that looking forward to the upcoming webinar that is being held, I believe at of the month. And thank you again to all of our partners. You've mentioned all of them, Dr. Amadi. Thank you very much. And looking forward to continuing this rich discussion, rich conversation towards really solving this critical issue of not only access to finance, but financing that works in the agrifood system. Thank you very much again to everyone. Thank you to the moderation. Thank you to the great team behind this excellent webinar. Thank you to all of our participants who have joined us from everywhere, and wishing you all a very good rest of the week. And thank you to you again, Dr. Amadi. Over.
No, thank you. So the meeting is adjourned, and thank you, everyone. Looking forward to the next webinar.